5 potential value stocks. These stocks are on my radar, and when they hit the prices I want to buy them at, I'm going to buy them and buy them consistently. First one, Microsoft. So right here on the board, Microsoft's currently at 248. Year to date, it's down 25%, Mo. Wow. Now, we don't care about that. Nope. All we care about is it selling for the price we want it to sell for, right? So let's do some quick look over here. First things first, market cap of 1.85, enterprise value of 2, very little debt. That's the difference, is the debt involved. Very little debt. A high 5-year PE, a great profit margin, a great 5-year return on invested capital, 25%. The market average is around 10% on a year-to-year basis. Yeah. Mo, what are your thoughts on Microsoft initially, just based on what you see?
Well, looking at the ROIC and the gross profit margin, I'm like, woof.
Yeah.
Something I want to own.
I know. And look at that dividend yield, 1%.
Dividend yield is good, 18.5 million. Shares outstanding, buying back shares, but not a lot. I like that.
The all-time high, guys, was a little bit over a year ago of 350. And now it's at 248.
Yeah, don't have to worry about debt either, really.
So let's go to the 8 pillars. It's our typical loving company.
Yep.
Has all the checks we love. And you know what else I like, Mo? They weren't very aggressive with the buybacks.
That's what I like about it.
So guys, we like buybacks, but we don't want companies to buy back expensive shares. If it's overpriced for us, it's overpriced for them. They are still deploying the capital that you have access to as a shareholder into an overpriced investment if they buy back their own expensive shares, right?
Exactly.
Mo,
right.
What are the analyst estimates saying?
So analysts are looking at earnings per share growth, mid-teens, $9.50 to about $20.
Oh, great.
And
doubling in the next 5 years.
Yeah, and on the revenue side, $203 billion to about $302 billion.
So basically 50% growth.
Digits, about 10% maybe?
Yeah, so 50% growth over the next 5 years. Okay, so they have ample growth potential still. Now, one thing that Mo and I have been doing, companies that have high ROICs that are moat companies, which I think Microsoft is, these are companies we want to analyze for a little bit longer than our usual 10 years. Now, that'll drive the price down a little bit, but we're okay with that. And we'll show you both the 10-year and 20-year numbers. So
and it really doesn't change it much.
But. Right. So stock analyzer tool. I'm going to do 20 years to start. Okay. Now, Mo, you put your numbers in, I'll put my numbers in. And then we'll meet in the middle. It actually is hard.
It is a lot harder. Not going to lie.
Because going 20 years out, now high ROIC. High ROIC really makes me put that premium on multiple of earnings and free cash flow. Because what they can do is they can reinvest their capital to higher income levels. So they can drive their income higher at much better levels when they have a high return on invested capital. Okay?
Yeah.
And then, all right, Mo, so what is your...
revenue side?
Revenue side.
3, 5, and 7.
Okay, I did 5, 7.5, and 10. I think yours is probably better than mine.
Okay. Profit margin, 28, 30, and 32.
Same thing I did.
Okay, same thing for price free cash flow.
Okay, I did 29, 30, and 31.
Okay. PE, 14, 15, 16.
So I did 15, 16.5, and 18.
See, I'm struggling with PEs when it comes to 20 years.
But there's a high return on invested capital. That's the goal there.
I know.
Go ahead.
And then desired return, 12, 13.5, and 15.
I did 12, 14, 16.
Okay.
So what I did here was, guys, I made higher assumptions here. So therefore, I made a higher desired return. Yep. Because the larger the desired return, that's my larger margin of safety. And the more aggressive I make my assumptions, the more margin of safety I need. So it's consistent there. I'm okay doing 16% return because I'm like, listen, for me to be right, it's less likely that I'm right. So I need a really high return to justify that. All right. So I hit the analyze button. 248 is the current price. Mo, what do you got?
I got $90 to $121.
See, I have 115 to 160 essentially. And I have my watch list at 195. Now, the reason it's on my watch list at 195 is
200. So
I can start selling puts at lower prices. Yeah. I think 90 is too low.
I think 90 is too low as well. I honestly probably would start looking at this around 140.
So I'm probably going to start buying shares somewhere in the mid 150 to 160, 65 range based on current numbers. But this is the point, guys. Mo and I are both value investors. We're both trained in the same ways. We have the same books, and we still evaluate companies differently. And that's the art of investing. Company number 2, the Google. The Google is currently at $100 a share, all-time high of 152.10, which was February 1st of this year.
Yeah.
Google's not going to go down. I still remember a specific comment when somebody said, this is before Google split, but they're like, Google will never hit that price. And it was a split adjusted like $1,700, which is $80. Look at its low, 83.
83.
And guys, I think it'll hit that again.
It's gonna go below that.
I think so too, just based on where markets go and how overvalued the stock market is.
Exactly right. I'm actually surprised by their ROIC. I thought it would be a little higher. The
14.4.
5-year ROIC.
Yeah, 1 year is 18.3. Yeah. All right. Analyst estimates. What do we got? Again, about 40% increase in EPS. What is that? A 30% increase in revenue? Yeah. Not big jumps.
No, it's really not. I'm actually quite surprised by the analyst expectations.
See, I don't know, because China has their own search engine, Baidu, and that's a big reason why. I don't know.
But for advertising, I would think that Google's probably better than Baidu.
Yeah, you might be right.
Yes. Okay.
Okay. So I'm going to we didn't do a 10-year analysis on Microsoft.
Oh,
we didn't run that on.
I still have this up. So
okay, pull it up.
Let me go 10 years on mine. Yours would be higher, obviously.
Yeah.
So I'm looking at 95 to 127.
So it added about $10 on the high side to it, not even. Yep. All right. So analysis for Google. I'm going to go 20-year analysis on Google. All right.
I'm excited to see your
4, 6.5, 9.
Okay, I did 3, 6, 9.
20, 22, 24.
21, 23, 25.
15, 17, 19.
15, 16, 18.
You did 14, 16, 18.
That's what I meant. I was listening. Did you say 15?
I did 12, 14, 16.
Same. 12, 14,
so,
16.
We're pretty consistent. I'm going to hit the analyze button. It's currently at $100. All right. Low price, 58. High price of 85. Mid price of 70.
Yeah, 54 to the high side of 88, middle ground about 69. And let me pull up 10-year analysis here. 10-year would be 57 to 91. So
my 10-year goes from 60 to 90. So we're almost there. We were there already once before. I think my watch list price might be a little low actually at $80.
I'm actually going to switch mine right now.
Yeah, I think so too. I think I'm going to change mine to 90.
I'm going to put 90 there.
Yeah, let's go to 90 on that one. So now the software is going to notify me when it hits $90 a share. All right, stock number 3, Palantir. Now, we've talked about Palantir a lot in the last 2 years because a lot of hypester idiots on YouTube were talking about Palantir being a great stock at 40 and 45. It's going to the moon. And we said, you're stupid. And we would be interested closer to...
Maybe they meant 450.
Who knows?
Just a thought.
So Palantir is interesting, and here's why. It's had 8 quarters in a row of positive free cash flow.
Yeah.
The income statement isn't as good, so it hasn't translated quite yet to profit on the income statement consistently. There's still losses every quarter, but free cash flow's up. They have $2 billion in cash on their books with no debt.
Mm-hmm.
So we're looking at this going, it's hard for a company like this to go under, and it is growing very well. Yeah. So this is a company that I'm watching as a possible multi-bagger. Now, that would be a company that we would buy, and then we'd watch it grow and grow and grow on itself because it's going to get high returns as a software business. Look at its gross margin. Go ahead, Mo.
And I like that switch that it's kind of doing from all more on the government side to more on the commercial side.
Yeah,
I like that.
Which, by the way, I'm still fine with government.
Sure. I mean, I think the government's like 45% or something. That's fine.
Yeah.
But I like that they've kind of switched the...
Yeah, so their average contract size is getting smaller, but they're getting more and more clients. So their goal is to use data to solve problems. As generic as that statement might be, it is what they're doing.
And they're not going to lose the government side.
And look at this gross
CEO
margin.
said it yesterday.
Oh, really?
Yeah.
Good.
We're going to still focus on it.
Look at that gross margin.
Huge.
That's 10% higher than Microsoft. Microsoft's at 68%. They're at 78.6%. These are huge gross margins. Now, obviously, profit margin is not there, but their free cash flow is growing. So when it comes to looking at the analysts, so look at the 8 pillars. It's garbage because we don't have enough data. However, we can go to the analyst expectations. So this year, it's expected to generate a slight profit, but grow tremendously over the next 4 years to $1.60 based on the average of these 8 analysts that we pull from our software. So at $1.60, and if you want to assign with major growth potential, a 25 multiple of the company, or whatever the number is, call it 20 multiple. Even call it 20. You're looking at $32 per share. Now, is this a guarantee? Absolutely not. Go look at analyst projections and history. I mean, they're not the most reliable things in the world.
Right. And it's not a company that's 100% out of the woods. It's just, it's looking good. It's looking better.
Correct. And it's been around for 18, 19 years, which is amazing.
It's not new out of nowhere.
And look at their revenue growth potential expected to double in the next
great.
1, 2, 3, 4 years. So that's 20-some% growth rate, 25, 20%, whatever it is. So there's a lot of positives here. The thing I like the most is they've gotten a free cash flow positive. They probably have enough cash on hand to not have to dilute owners by issuing more shares for capital, and their gross margin's huge. Mo, tell me.
Their shares that they've done dilution on. I mean, it's
been insane.
It's been insane.
It's over doubled.
More than doubled.
Yeah, more than doubled. All right, so let's go look at Stock Analyzer tool. Now, the issue with the Stock Analyzer tool here is we don't have a profit margin yet. Yeah. And the free cash flow is probably low. So my recommendation is to start with low numbers and then get aggressive. Now, with 78% gross margin, you look at Microsoft. They have a gross margin of 68% and a bottom line margin of 34%. To me, I'm thinking to myself, that's probably the high end of Palantir, because the difference between gross margin and profit margin is paying your overhead and taxes. As a company is smaller, overhead's gonna be a bigger percentage of your overall revenue. So it's gonna eat it up a little bit more. So I'm gonna be conservative, but I'm also gonna be on the high side, a little bit aggressive, and we'll see where it goes. So Mo?
Okay. 10-year analysis?
10-year analysis. Okay. You know, one of the things I did, and while Mo finishes up here, Slowpoke Mo,
I'm thinking about this profit margin. I'm just trying to put a reasonable thing on it.
You know, I look at desired annual return, and since it's such a speculative play in the sense of, you know, we don't know where this thing is going. I'm probably being too high on my desired return at the low end, but I look at it going, listen, there's when companies are young, there's a lot of unknowns, and you have to factor in. Okay, Mo.
I'm probably too low on the low end.
Revenue growth percentage.
12, 16, and 20.
I did 10, 17 and a half, and 25.
Okay.
Profit margin.
17, 21, 25.
So I went wider. I did 10, 20, and 30 for both profit margin and free cash flow margin. Because I think, and by the way, the reason I did the same is even though the earnings has not come out in terms of being consistent with the cash flow over a long period of time, software is a business that has a very consistent earnings to free cash flow ratio.
16, 18, and 20 for PE and price to free cash flow.
I did 15, 18, and 21.
Okay.
And then your desired return.
15, 20, 25.
Okay, I did 14, 17, and 20.
Okay.
All right, so let's hit our analyze button. The stock is currently at $7.
Consistent for me.
I have $1.66 in the low, $11.70 in the high, $5 in the middle. Go look at our video. What do you have, Mo?
I have $3.14 on the low, $4.71 on the high, and about $4 in the middle.
All right. So if you look back at our videos back in when the stock was at $40, $45 a share, I said I'm probably interested around $5. Every time I run this analysis, it goes between $4 and $6 for my middle number. And I don't think these middle numbers, though, are really high. So I'm probably being conservative, but
I like that I put in a 20% return here, and I still am around the number that I wanted at.
Yeah. Yeah. So that's pretty good. And probably, by the way, if I put in Mo's assumptions here for 15, 20, and 25, I'm at $1.55, $4, and $8.
There you go.
So I do think this is a company that has a lot of multi-bagger potential. It's not out of the woodworks yet.
No, it's not.
But Peter Thiel is one of the founders. He has done very well investing his money. So that's the way I look at it. All right. Next stock, a little company called Berkshire Hathaway.
Never heard of them.
Now we're going to look at their Class B shares because their Class A shares are $400-some thousand. Now, Berkshire Hathaway is a little bit different how I'm going to look at it. I'm going to look at the analysis very simply. Okay. Mo, look at their income statement. This is very interesting. Look at their net income over the last year versus previous years.
Ooh.
Now, why is that?
COVID? Insanity?
No.
Why?
So look at these numbers, guys. We have 19, 62, 26, 36, 86, -1. Yeah. Very big fluctuations. Well, Munger and Buffett have been very against this. But the U.S. government, the SEC, said from now on, at a certain point in the past, 3 or 4, I don't remember the exact date, you must report gains and losses on your stocks that aren't even sold yet. You have to mark to market these stocks. Unrealized gains and losses have to show up on the net income statement. Look at your face.
So this basically screws financial statements.
So
because everything changes.
Right. I'm not even going to look at the net income line at all for Berkshire Hathaway ever again.
Yeah.
And that's the reason why. So let me give you an example. This is why I don't like it. Normally, if you buy a stock for $10 and it goes to 15 and you do not sell it, you've had zero gain.
Right.
If you sell it, you have a $5 gain. Now, the U.S. government is requiring them all that if the stock goes to 10, from 10 to 15, and you still own it, you didn't sell it, you have to report a $5 gain on your income statement for the companies like Berkshire. And guess what? Buffett and Munger are absolutely against it. So it's going to cause too much fluctuation in the net income numbers for Berkshire. Wow. So I'm going to look at Berkshire in one way. There's two ways to look at it. You can still focus on free cash flow, because Mo, go look at the free cash flow statement. Look how much more consistent the free cash flow is. It still fluctuates 33, 21, 21, 27, 29, 20.
It's a normal fluctuation.
Correct. And they're an insurance business. Yeah. So in a year where there's a lot of claims, and this year has been so they're going to have a lot more problems, but it's going to be a lot more consistent. Right. So the way I'm going to look at it is this. I'm going to take this is going to be a very simple analysis. Warren Buffett's always said he will buy back shares in Berkshire when the price to book value, and book value is assets minus liabilities, was essentially stockholders' equity. The market cap is less than 1.2 times book value. We go to the balance sheet. Assets minus liabilities is shareholder equity, $455 billion. So 455 times 1.2, we want a market cap under 546. The current market cap is 680. So the stock would have to fall to 455 times 1.2 divided by 680 times, what's the current stock price?
308.76.
We need a price of under 250. So that's basically what I'm going to do. I might pick a little bit lower, go to 240 and say, you know what, Paul? Buy the stock if it goes under 240.
So it's interesting. I look at the share buybacks and they were consistent, and then all of a sudden in 2020 they started buying back.
Oh yeah, because 2020 the stock probably fell a ton. Yeah. So Berkshire Hathaway, I have it on my. I'm going to add it to my stock list below 240 just to be. Now let's go 250 because I can sell puts on it. Notify me, and that's it. It's very simple. I'm going to listen to the guy who owns the company and says, listen, the best capital allocator of all time says we're going to buy back our shares when it sells for less than 1.2 times book value. That's all I'm going to do. That's pretty much my goal. They're a diversified holding business, and everybody rows in the same direction. Our final stock, the Nike. So Nike just canceled their contract with Kyrie Irving.
Oh, did they?
Yeah, you didn't see that?
No.
They were paying him $11 million a year, they said, that it was reported. And they canceled it because of his anti-Semitic tweet.
That's why I was seeing like Kyrie's shoes everywhere all of a sudden. And I was like, oh, that's probably what it is.
Yeah, I mean, to lose $11 million a year because of a tweet.
That's why I got off Twitter.
I mean, it's ridiculous to me. I don't know. Not ridiculous on the Nike front. On the Kyrie, Kyrie, just keep your mouth shut. So let's see. When the last 1 year, the stock is down about 35%.
Wow. Yeah,
let's go to the 8 pillars here. All right, cash flow is a little bit down. I don't know if I'm necessarily worried about that for a company like Nike. I think they're trying to work through some inventory, get some inventory out. So I'm not as worried about that. Very consistent PE and price to free cash flow. So it's just about where we're going to buy it at. So let's go to analyst estimates. Analysts are expecting almost doubling of EPS in the next 5 years, and revenue growing at about, mid-single digit growth rates. Now, what's their 5-year return on invested capital? Wow, very high return on invested capital. So guys, the biggest question with ROIC is, are there still opportunities for growth that allow them to reinvest that capital at high rates of return? They're paying a 1% dividend. Okay, not bad. I don't know why.
I don't know why either.
45% gross margin, very consistent profit margin. All right. I don't know what to say besides I'm not blown away, but I'm not. I mean, Nike to me is a company that has an amazing brand. I want to own it for a very, very long time. But of course, I got to buy it for the right price.
Yep. Let's see what the price is.
Let's go to our stock analyzer tool and figure. I'm going to go 20 years on Nike.
Okay. All right. What'd you do? 246 on the revenue side.
So did I. Look at us.
10, 11, 12 on profit.
See, I did 9.5, 10, 10.5.
You're not counting for inflation.
You're probably well. No, inflation would hit both. But go ahead.
Yeah, I know. Free cash flow margin 10, 11, 12.
Did 9, 9.5, 10. They never did. They never did.
Oh, look at that.
In the last 10 years, they haven't done 10, 11, or 12.
You're right.
So I don't think that's being conservative.
I didn't really pay attention to that.
What'd you pay attention to?
I just looked at it and I was like, oh, I'm sure Nike is about the same.
Yeah, maybe you're right. But either way. Okay,
All right.
PE and price of free cash flow?
15, 17, and 19.
I did 14, 16, 18. You're probably more right than I am on that one.
I thought 19 would be a little bit high.
The issue is on the low side, I think. I think I'm just being a little dramatic on the low side.
Yeah.
And then return?
12, 14, 16.
I did 12, 13 and a half, 15.
Okay.
All right. Stock price. 30, 40, middle of 35. Guys, it's just numbers. I mean, could it be bigger? The whole point is at 108, it's too far off.
Yeah.
Do I think I'm low? What do you think, Mo?
$32.50 to $43, middle ground of 38. It's on my watch list at 80 to sell puts, and 80 might be a little bit high to sell puts.
I have it on my watch list of 55.
Yeah, I think
'Cause I don't think you're not going to get good options at 80.
Nope. That's why I think it's high.
All right, guys. Great news. If you love this software, if you want to join the thousands of people in the community who can talk about all of these aspects, we have a no-risk offer for the next month. Join our community. It's $1 a day. If in less than 30 days you don't like it, email us. We'll cancel. We'll give you your money back. No questions asked. Go to everythingmoney.com. Thank you very much. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?